Good morning. I'm Kevin McKechnie. I'm Executive Director of the Office of Insurance Advocacy of the American Bankers Association in Washington, D.C. And in that role, I'm supposed to advise bankers and customers on the best way to manage their insurance problems. And because I have that role, our good friends at the Australian Bankers Association thought I might be of help to you. And so I'm joining you in a way that I had hoped would be avoidable, which is by video. I wanted to be there in person, but alas, some things can't be managed just now. I was very surprised to get the call and a little skeptical that you wanted to have me there because, of course, to paraphrase Mr. Churchill, we Americans do arrive at the right decision, but only after exhausting every other possibility. And that's exactly true in our insurance policy. You have more than likely seen all kinds of news stories about climate change and the effects of global warming and so on. And I won't touch any of that today because I can't measure it. And more to the point, insurance companies don't seem to be able to do that either. What they can do is what they always have done, which is measured frequency and severity. And we found a trend line that I think will interest you and will speak to the problems you're experiencing in your businesses, just like American bankers are experiencing problems in theirs. There's a huge number of people living in much more expensive buildings, almost exclusively on the coast. And this makes some sense, doesn't it? Because you can't imagine anybody migrating from different parts of the world hoping to live in Wichita, Kansas. It just doesn't work that way. They want to live in Miami, they want to live in Boston, they want to live in San Francisco. And in your country, I'm sure they want to live in places like your capital city, which I know is not Sydney. It's Canberra, and that's the geography lesson for the day here in America. Some issues. The population is growing. Let's just set the table so everyone understands what the problem actually is. And I'm going to use the period 1990 to now in both countries. Our country, the United States, has grown by about 100 million people since 1990. That's a lot of people. That's a lot of people to stash in a very thin band of land, starting on the North American continent's eastern side and running to the tip of Florida, which is where most of them live. Your country has had the same growth, not the number of people, but it's grown by 10 million people in the same amount of time, and I would imagine all of them migrated to Sydney or parts on the East Coast where most of the people in Australia live. What do they live in? I'll use myself. I've been very fortunate. I used to live down in Florida with grandparents. We would winter there. What a great time. You can now, or have to, drive at about 60 miles an hour, 100 kilometers an hour, for those of us who haven't converted yet, all the way through the Everglades for 20 minutes to see those same Everglades now. It's all houses. And because it's all houses, these storms have nowhere else to go but through houses. And so what do you do when you have more people living in more expensive homes, very close to the water, and you notice that frequency and severity is going up? Well, how much is it going up? In the last 5 years, every year we see about $50 billion worth of damage. In the previous 5 years, the average has been only about $16 billion. That's a lot of damage. And it speaks to the question of inflation. Inflation affects absolutely everything, and there's an extraordinary period of inflation going on right now, as only bankers would notice. Everything's more expensive, including all of the materials you need to make things. Now, there's some broad changes in the global economy that you're going to like, and that is reshoring from China. And so as the supply lines get perhaps shorter, costs may come down. But those supply lines have not reoriented yet. They certainly haven't reoriented in the United States. And so rebuilding homes is more expensive, not because the homes are more expensive. It's more expensive because of inflation, supply line problems, and getting your hands on the labor in the first place so that you can rebuild these structures. How often do they blow down? Well, keep this in mind. When we talk about events, we've had about 102 $1 billion events in the last 5 years. That cuts by a third in the previous 10 years, cuts by a third again in the 10 years previous to that. So there's an acceleration effect going on here. That acceleration effect may keep going. I don't know. I'm not qualified to speak to it. What I am qualified to say is that the capital does not exist in the insurance companies we all rely upon to secure our collateral. What can be done about that? The quest for capital is where we need to focus our attention. Bankers are uniquely suited to that endeavor. What I recommend is this. We're all competing for the same global reinsurance capital. All of us. Where should it go? Well, it's going to go where the return on investment is greatest. Where would that return be? Well, it will be most likely where claims are going to be lower. And so how do you mitigate claims so that you can attract reinsurance? How do you mitigate claims so that you can recapitalize the primary insurance companies that backstop all of our homes? Best way, and what's going on here, is we're going to see insurance companies start shedding risk. How are they going to do that? Well, they're going to tighten up their underwriting policies. They may avoid certain areas of the country that are prone to risks, prone to flooding, for example, prone to hurricane, prone to tornado. They may greatly increase the deductibles, which you might expect them to do because the most expensive dollar to insure is the first dollar. It's getting not much more efficient to insure that $1,001st dollar. And so here in the United States, we're thinking about deductibles that are truly higher than previously experienced, $5,000, perhaps $10,000. And we're already seeing in lines like earthquake, a percentage of the replacement cost of the house. That's the deductible. Why would we allow this? Well, we want to allow this because we need insurance companies to be well capitalized. And so that you're aware, just in Florida, the combined loss ratio now greatly exceeds premium. And so an insurance company is spending $1.04 to $1.07 and only collecting $1. Now, the climate isn't the only reason things are changing. We are also focusing on some abuses in the government system, and Australia may have an edge there. The United States of America is 56 separate political jurisdictions, each with their own insurance commissioner. That's not true in Australia. And so back to attracting capital, you may be able to do that more efficiently because you have a national insurance regulatory system, and that means an efficient one. A couple of other things to keep in mind. This is not all bad news. We have some other ideas too, something to focus on. We're going to look at what we call disaster savings accounts, building on health savings accounts. We're going to look at the proper role of government. Should they be in the reinsurance business? We don't know, but we're going to explore it, and there's going to be hearings, and there already have been some. We're also thinking about parametric insurance and selling on our exchanges the chance for people to invest in resiliency. A word on that. If you want to mortgage homes, you should try to start thinking about building codes, and especially robust ones at that. And so in places like Louisiana, for example, you can't build a house with just a normal roof. It has to be what's called a resilient roof. That makes claims go down because those roofs survive much longer. That's, I suppose, where we should close, and it's not a good note, and I'm sorry about that. I think there's going to be fewer mortgages, and that's because I think there's going to be, for the short run, fewer people that can afford the variable cost of increasingly expensive insurance until we've been able to recapitalize the insurance companies through the risk-shedding strategies I've described already. I suppose I'll also close with a heartfelt apology for not being there in person, because these are the kind of subjects that take us days to fully flesh out. And I pledged to our friends in the Australian Bankers Association, if you have questions, get in touch with them. They'd be happy to get in touch with me, and I with them. We're brothers and sisters, remember. And so we're going to go through this together, the United States and Australia. I'm looking forward to the journey, and always happy to answer any questions, and looking forward to when I can come and see you in person. Thank you very much for your time.
Well, that was Kevin McKechnie from the American Bankers Association, and we thank him for his time in pulling together that message to us. He has painted quite a serious outlook for the insurance sector, and that is as a result of a confluence of a whole lot of factors, including increasing incidence of perils, the increasing magnitude of those perils when they do take place, the densification of houses along beautiful tracts of land that people want to live in but are nonetheless perils-prone land. And because of a quirk of the US insurance market, the cost of supply, repair, etc., is all going up, and so that is what is causing the issues that Kevin described. So with that context, it'll be really good for us to now dive into the Australian context and really consider where is Australia at in terms of climate perils and consequences that might have for insurance. And to kick us off in this discussion, I'm going to turn to Sharanjit. Over to you.
Thanks, Emma. So first chart I think we have up. So the first chart here shows you what's been happening with extreme weather conditions in Australia. This is an analysis we do for the Australian Actuaries Index. It goes back to 1980, I think. And you can see there's a very clear trend that what is happening in Australia in terms of extreme weather events, things like high temperatures, heavy rainfall, changes in sea levels, that has been increasing over the last 2 decades quite clearly. Next, and by the way, this is all actual data. There's no modelling here. It's just what's happening in the weather conditions that we see out there. Next slide. This is showing the losses in the Australian insurance markets from extreme weather events or catastrophe events. Now, there's 2 things I'll note about this one. One is we've normalised for inflation, so that effect that American colleague talked about, we've taken that out. And the second thing, we've also normalised for the densification effect. So that means that things like Cyclone Tracy back there are huge numbers, because if they happen today, that's what we think the cost would be. But you can also see here that the costs of natural disasters, even normalised, are increasing in Australia. It's a very volatile trend, but it's very apparent and clear. So those 2 factors that are in terms of the climate impacts, the impact of delayed action on climate change for the last 20 years, we're seeing that very clearly in both the weather statistics and insurance statistics today. Next slide. So what are the consequences of this? So one of the analysis that we do, again for the Actuaries Institute, is looking at what impact this has on home insurance affordability in Australia. So we go and calculate an insurance premium for every house in Australia. We compare it to household income and say, how much is your insurance premium going to cost you in terms of weeks of income? And we did this first in 22, and at that time we saw that 1 in 10 households in Australia faced insurance premiums that were more than a month's worth of income. So that's 10%, probably unaffordable, they're probably not buying it. In 1 year, that grew to 12%. So that's another 250,000 of households whose insurance was likely unaffordable in the space of 1 year. We're redoing this analysis this year, and we will see how much that number has grown again. So there's a few things I want you to take from this slide, which is that insurance is rapidly going out of reach for many households. And there is part of that. Last year, about half of that increase was because of the building cost inflation. It costs more to build a house when it falls down, so the insurance is going to go up. But the other half was very clearly disaster-related and driven by reinsurance costs going up across Australia. So we expect to see that carrying on. So things I want you to take from this. One is that actually, 7 out of 8 households, insurance is fine. It's about a couple of weeks' worth of income, and it works well, and it's all fine. It's actually about this tail that starts getting bigger and bigger of people at the edges who can't afford it. If you just looked at average impacts of climate change, you won't see very scary numbers. You have to look at the tails to see what happens to people at the edge. I'm reminded of Shane's comments that people who buy mortgages aren't necessarily the average Australian population. And you have to look at what's happening to change that market over time, and this will have an effect. The second thing is, what's the implication for banking? This is all about insurance. Well, there are 2 effects. One is, if your residential lending customers aren't buying insurance because they can't afford it, and they get hit by a cyclone or a flood, that's going to be a credit loss, a very significant credit loss on your books. We've already seen the big banks reporting those numbers, and that number is going to increase over time. Secondly, if you are on a new loan or a refinancing of the loan, the customer can't get insurance that's less than 30,000, that's not a loan that your lending conditions allow you to do in the banking system. People have to have buildings insurance. So we're updating this report, as I say, recalculating this home insurance affordability. We're trying to estimate how much lending in the system will disappear because there is no associated insurance with it. We're going to be publishing that next month. And that is going to be a loss to not just the insurers, but the banking system as well. Thank you.
Thanks, Sharanjit. So last week, the Insurance Council of Australia released some more recent information on catastrophes and claims data, and their figures are at 10.6 billion in total losses last year across 490,000 claims, and that's since 2022. So it doesn't include that horrendous bushfire season we had in 2019 or anything in between or previous to that. So quite significant numbers there. Alison, what is your perspective from a reinsurer view?
So reinsurance is a global business model. We very much rely on the diversification of risk across the globe for it to work. And we stand behind the insurance companies to really shore up their balance sheets in case of particularly large events such as natural catastrophes. We've seen a very similar trend worldwide in terms of where these insured losses are trending. And it is, I think, as Kevin outlined earlier, it's driven by increases in asset value, it's driven by shifts in exposure into areas particularly exposed to natural catastrophes. There's also very much in Australia the influence, the indexation that we've seen in terms of building costs and rebuild. And on top of that, we add the climate change signal, which is increasing frequency and severity. So what this means for reinsurers, to have a sustainable business model, the same as an insurance company, we need to collect enough premium to cover that. And looking at these kind of trends at the moment, we're seeing what we think of as a protection gap, which is the difference between economic losses and insured losses. Australia has, I think it's number 8, we think, worldwide in terms of percentage of GDP coming from these climate risks. And if this kind of uninsured proportion continues to increase, that will become an even bigger problem as climate continues. I think in terms of what we're seeing in international responses, a lot of short term, perhaps there's things that can be done around frictional taxes, around reinsurance pools and other things. But really the key is adaptation measures to try and reduce those economic losses from the natural catastrophes. And I think that's really where the role of banking can come into play too.
Thank you, Alison. I want to move us on to talk about the role of government and regulators. And to do that, I just want to reverse back to a comment that Kevin made where he said that US-based insurers are in urgent need of recapitalisation. Now, that is not the case in Australia. APRA, at its recent, in February, in its appearance into the inquiry into insurers' responses to the 2022 major floods, actually said that the general insurance industry remains very well capitalised and in line with APRA's requirements. So the Australian insurance sector isn't experiencing the same kind of capital squeeze as what our US colleagues are experiencing. But despite the fact that they have made losses just in their home insurance businesses over the last cumulative 5 years. So with that context, with APRA saying capitalisation in the insurance sector is fine and above APRA standards, what does that mean for regulators? What are regulators doing? I'll start with you again, Alison, and let's go to the global context. Like, what examples are there out there in terms of how to respond to this?
So what not to do is, I think what we've seen is a real crisis, for instance, in the California insurance market. So I don't know how much you're aware of this, but that market by itself is the same size in insurance terms as all of Australia. But because of the bushfire risk, what they call wildfire there, and the fact that they have this piece of regulation called Proposition 103 that says insurers cannot use catastrophe models to price in expected natural catastrophe risk, and they also cannot use reinsurance costs to pass on to policyholders. They can look only at very limited historical costs. That means that they're in a loss-making position, and so we've seen the three largest insurers essentially stop renewing policies, refuse to issue new policies for areas that are extremely wildfire exposed. And this has led to really a crunch in the insurance market there. Policyholders aren't able to get insurance anymore for the purpose of mortgages. They've been pushed into what's called the insurer of last resort, which is the FAIR plan. And then you have an underinsurance problem because it only pays a much smaller sum insured. Only now are they coming to address that, and also within that regulation to come back to adaptation measures to actually get insurers also, as we've already started doing here, to look at the adaptation measures to reduce the risk itself that the policyholders are taking and include that into insurance pricing.
Alison, I recall when we were last chatting as well, you mentioned the UK pool as well. I'm wondering if you might want to elaborate a little on that.
Yeah, that's a great one actually. So this is actually about post-event adaptation. There's a UK pool called Flood Re, and as part of the benefit that they pay, they allow another 10,000 British pounds over and above for the cost of making repairs in addition to make that property more flood resilient post-event. So that might include things such as putting in flood barriers on doors, raising electrical sockets and others. But it's essentially really about making that housing stock more resilient to flood so that it can be insurable long term.
Thank you. And Amanda, in terms of the local context, local government and regulatory context, what are you experiencing as someone on the cold face at a bank?
Yeah, I think in the financial services space, we've had APRA's CPG 229 for a while around climate-related financial risks, which tells us how we need to be thinking about some of these. But I think more broadly with the new sustainability reporting standards coming in, the way that AASB, the new audit standards coming in as well, we will now be required to be a lot more transparent in how we are communicating what those risks are. And that's not just for financial services, that's across all industries in Australia. So I think what we will start to see as you get more of that transparency, will be really interesting as to how Australian organisations are interpreting this change in risk.
And in terms of APRA's risk work in terms of the stress testing that it has undertaken with both the banking sector and is now underway with the insurance sector, we've just had John talk to us about the focus being on insurance affordability. I suppose we don't have too many insights on where that's going, but did you want to make a comment on?
No, I think what we're seeing though is that it's a systemic risk. When they did the banking CVA with the Big Four and Macquarie, there was some insights from that led to an insurance CVA. It may not be a banking risk alone. We start to see that it becomes systemic across the system then.
Yeah, thank you. I must say I've been going through some transcripts from APRA, and APRA have very clearly stated that they are not looking to block signals to market. And I'll just use this quote from them. They've said that to remain prudently sound, insurers must set premiums that accurately reflect risk, recoup costs over time, and ensure that they are able to access sufficient reinsurance protection. So that should give us a fair understanding of where APRA expects insurers to price their premiums at, and therefore the consequences, as Sharanjit was talking to about the affordability of those insurance premiums. Thank you. In this next section, we're going to look at some consequences and opportunities for banks. And I'd like to introduce you all to Kate Cotter. For those of you who don't know her, she's Chief Executive of the Resilient Building Council. And Kate and I have been tic-tacking on and off for about 4 years. And Kate, tell us about how homeowners can use their own agency using a tool that you've developed with support from, I think, one of the ABA members as well as government. Tell us about this tool.
We've spent sort of the last 10 years on a fairly complex project, which is resilience ratings covering bushfire, flood, storm, cyclone and heatwave. And the Commonwealth gave us some seed funding to take that sort of rather technical program of building assessments to the public, so providing a free self-assessment app. So the first phase of that came out in October for bushfire, and we're getting about 1,000 people a week complete their assessments, which is great. We're not doing a whole lot of marketing around that, but we're just building up to that now. So through that self-assessment, households can assess their own home. They get a rating for how their building, how resilient their building is at the moment, and then they get a report that tells them what specific items that they can do to improve their resilience rating, and they get an indicative rating of what that would be. So this was really developed out of the Black Saturday bushfires in Victoria in 2009, where households really just wanted to know what could they do and what would be effective. So we measure the resilience of buildings by measuring their performance against local risks. So that measurement's really important both for households themselves, so they know what to do and what will work, but also for insurers. And so we've been able to integrate the resilience ratings into insurance pricing with the first two bank insurers coming on board in March. So they can provide discounts now for people that achieve 3, 4 and 5 stars. So in a practical sense, it starts with hearts and minds on the ground, house by house by house, by community by community. But I guess the systems impact is around de-risking property in general. So we have to address that underlying risk if we want to be able to reduce insurance premiums, reduce finance costs, to reduce reinsurance costs. That is sort of the essential thing we need to do. So these tools are around giving people agency. They can do a lot of things themselves. It provides a mix of little things and big things, so some things don't cost any money. So we're seeing a huge amount of risk reduction just since the bushfire one was launched in October that isn't costing people a lot of money, but they do have a plan in place for when they might want to do a bigger retrofit. They might want to do some bigger items, and that's where the banks are really been great. NAB has been trialling a whole of mortgage discount. So there's a real, I guess, positive role for banks to play here to help finance adaptation at scale, and there's lots of benefits to that, across your whole portfolios, being able to demonstrate that risk reduction, but most importantly, helping customers be insurable, helping them. The main motivation for our households is not really financial. They want the financial recognition from insurance and banking, but it's very much driven by protecting their family and their home. So that's why so much action and private investment from households is happening without needing much assistance. And I think from a government perspective, we use these ratings also to be able to look at where that physical vulnerability and social vulnerability intersection is. And the Actuaries Institute work and Sharanjit's work highlights that crossover. And that's where we sort of get government to really try and focus their investment to make it really efficient and effective for those without the financial capacity to do this adaptation work themselves. So I know there's, talking about the risk is pretty overwhelming, and it's overwhelming for industry, it's overwhelming for households. So these really practical, what can I do? How effective will it be? The rewards, it's really important. It's providing people with hope and security and a clear pathway.
Thanks, Kate. I hadn't realised your journey had been a decade long.
Yeah, it's a long,
Well
long
done.
one.
Amanda, what kind of opportunities do you see for the banking sector in light of everything you're hearing today?
And I think before I go into the opportunities, it's really important to understand the challenge, right? We're banks, we're here to take risks, we're in the business of doing that. And what we're hearing here, whether it's globally or from Sharanjit more locally in Australia, is that the controls that we've had in place to manage some of those risks, the outlook for them may not be great. It may be deteriorating, and we need to think about that. I think when you look at opportunities like what we're hearing out of Kate, to help us understand, to help our clients understand what their inherent risk is, based on what their properties look like, what their residual risk could be if they are able to make upgrades to those properties. That manages some of the affordability challenges if the insurers can translate that into premium savings, but it also manages some of the challenges that banks face into as well if we get to a point where customers can actually afford to insure their properties. So I think that there's some real opportunities there around how we support collaboratively the insurance industry and organisations like Kate's to bring some of these initiatives to light so that we can manage our risks longer term.
Thank you. So we've sort of had a meandering conversation here. We've started with the American Bankers Association and their outlook in the States, and we've traversed into the Australian context and the way in which the global context impacts upon Australian insurance, but also what insurers are going through at the moment with increasing perils happening and the claims and the like. And we've spoken about the potential consequences and opportunities for banks, and also the importance of educating customers so that they can take agency and feel as though they've got some sort of control over their destiny as well. In summing up, I'd just like to give each of our speakers a couple of minutes to offer their reflections to the room. So we've got a group of bankers here and associate members, people who can actually make a difference in this policy space. What would you like them to take away as your parting point there? And I'll start with you, Kate.
I think for banks, there's just a huge potential here for a whole lot of new lending that's really going to help the nation, and it will have systemic benefits across the economy and socially. So we're talking to a lot of you in the room about how to do that and the types of financing and advocacy and policies that we need to really accelerate this rapid adaptation that's required to keep our social and financial systems stable and keep us thriving.
And Amanda?
Building on Kate's, I think one of the challenges in this space is that it's actually relatively inexpensive for our customers to adapt their properties and their assets, which means that when they do want to borrow more money to do that, it's not always a big loan, which means that for most of us in the room, it's not as profitable to lend to. So finding a way to make those smaller ad loans profitable is going to be really important to ensure the resilience of the system. And I also think really starting to dig into the values alignment that can come. So if an organisation is prepared to do that small ad lending to build resilience for customers or to help them to protect themselves, what loyalty does that create, right? At what point then do we find it easier to retain customers through those opportunities? And I think that that's not well understood yet. So I really think there's an opportunity there for banks.
Thanks, Amanda. Over to you, Alison.
So I'm going to cheat with the 2 point. Innovation. I think there's a real role for banks to collaborate with customers and with insurers in terms of some of these innovations geared towards adaptation to actually reduce the risk. So something like a Build Back Better, also parametric type insurance to reduce some of that risk. And I think the second point may be to point out currently globally, all of the large-scale adaptation financing, so for instance, bonds issued to finance adaptation projects, less than 2% of that comes from private sources. Now, there is a real need, I think, for banks to get involved in do what they do best, facilitate some of that work to actually drive some of these infrastructural works geared towards adaptation.
Thanks, Alison. And Sharanjit.
Yeah, so look, I think it's very rare that you come across something that has so many wins for so many people. And resilience lending is like that, right? So if we're lending money to people to make their home more resilient, you are reducing their risk, you are reducing your own risk, which you're going to have to declare under ASRS. You are doing additional lending, and yes, there are some issues to work out, but that, we're all looking for volumes. There's an opportunity to do that. If we get the system setting right and the policies right in government, you can then securitize all that additional lending into a climate adaptation bond, which, again, if we get the settings right, there will be plenty of crazy European investors wanting to throw money at climate adaptation bonds. So you're making money not just from the lending, but you're reducing your costs of funding for this work. The social outcomes, the outcomes in terms of your customer loyalty, the outcomes in terms of your social license. These things don't come along very often where, as a financial services industry, we can make a massive difference and can actually win on so many fronts. The problem is, of course, that, Amanda and I were talking about, it's like connecting all these ideas. This is a bit new, it's a bit different. People don't necessarily have all the skills across this to map it together. But I sit there and I say I have yet to see a bigger opportunity. And if we just sort of zoom back out again, Australians have a love affair with their homes and their properties. This is the root of a big chunk of our economy, big chunk of our economic activity. There is a once in a lifetime opportunity for us to make that safer, better, cheaper, all those things. And I want the dinner party conversations to be not like we're going to put in a new kitchen to improve the property value, or we're going to build another bedroom, or do this reno. It could be, oh yeah, we're going to raise our floor height by 5 centimeters because that will reduce our flood risk and give us a 5-star rating from Kate and her crew, right? And our bank is lending us the money to do that. So I think there is a way here where we can harness all the pieces, that this isn't a story about risk and doom and gloom, but a story about value and opportunity.
Thank you, Sharanjit. I think that's the first time I've heard a marketing pitch from an actuary. That was brilliant. Well,
it's all the numbers. That's what they're saying to me.
It is. Well, that brings us to the formal end of this panel today. And it really was an opportunity for us to explore some of the challenges that our colleagues in the insurance sector are experiencing and facing into at this point in time, and how banking is inevitably going to interface into those problems as well. This is a complex problem, and in social policy terms, it's what's called a wicked problem as well, because we run the risk of leaving some of our population behind if it's not done well. It is a cross-sector, public-private policy issue, as Alison has very eloquently explained to us today. And I look forward to continuing these discussions with many of you in the room. But for now, I just want to thank Sharanjit, Alison, Amanda and Kate. Thank you very much.
We're going to... Time allows us to take a couple of audience questions too, because I can see a few people who are itching to ask questions of the panel. I'll start with one, and then just throw your hands in the air if you've got questions you'd like to ask of our microphone wranglers. Alison, you might be the best to start with this. We've heard that when it comes to the relationships with banks and cash and devices and all that, younger people have a bit of a different attitude to this sort of stuff to older people. What about with insurance? Where is the sort of millennial and the TikTok generation and all that on... attitudes to insurance as a concept consistent across age groups? What are the sort of trends that drive the way younger people think about insurance as a thing?
I would say most younger people don't find insurance very exciting.
Mm-hmm. Yep.
Yeah, but I think seriously, I think they're more likely to access insurance in the same way as banking, on digital platforms, they expect more flexibility. But I think inevitably when people move into asset accumulation stage, insurance, whether it's a car or a house, they become much more conscious of what insurance is and required. Just the way that they would choose to access the insurance and the flexibility they want in the product would be different. But Sharanjit, maybe I can kick that one to you.
Look, I have to agree that, if there's anything less sexy than banking, it's definitely insurance. I think...
Where do actuarial studies rate on that?
Wonderful. Absolutely
wonderful. I am joined actually because Alison is also an actuary, so I'm not alone up here this time. But I think also, the trends that we're seeing with asset accumulation happening later and later, like younger people aren't really starting to think about insurance well into their 30s. And that's a trend we're also seeing across the market, yeah.
Got some audience questions. Microphone there. What would you like to ask?
Hi, Matthew Martin from Mortgage Stress Victoria. We're a consumer advocacy organisation. There's many people out there who have a lot of equity in their homes, but they don't have the income to be able to pay for their home insurance. And I also find it interesting that despite it being in the interests of banks for their customers to be insured, the only involvement that we see in ensuring that they have insurance is at the time of lending. So my question is, notwithstanding add-on insurance restrictions, does anyone in the panel think there could or should be a role for banks to play in ensuring or helping consumers to pay for home insurance, say through access to equity or some other means?
I'm happy to take that one in the first instance. I don't think the banking sector should rule anything out yet. But I think there's a lot of work that we need to do to understand what the best solutions are going to be. I think it comes back to some of the points that Shane made earlier around people needing to access finance to be able to get into the market. There's some questions we've got to ask and answer about if we can't afford the insurance, should we be in the market? And I think that, again, we don't have the answer to that yet, and we're not going to be able to answer it alone. We're going to have to work with the insurance industry to do it. We're going to have to work with government to understand, from a lending criteria perspective and a regulation perspective, how we might need to collaborate, I think, to answer that.
Anyone else on the panel want to have a swing at that one?
Yeah, so I think, let's say we got a hypothetical situation with someone with a $30,000 premium because they happen to be in a flood zone. Does it make sense for the bank to allow them to access their equity for that? Like, how long will that last before the equity's gone? So, there might be some short-term role, I'm not ruling it out, but what I think is, I think the panel's all been consistently saying is that really you're much better off giving them the money to make their house more insurable and bringing that $30,000 cost back down to $2,000. In the longer term, insurance is just a price on risk. If you really want to bring down insurance, you have to bring down the risk. And the better place for banks to act, in my view, is to help customers bring down their risk rather than this cost, because it's going to carry on increasing. Like the impacts of climate and even all of that, that 30,000 will keep on going up. And you're not solving the problem just by lending the money for 1 year to do that or accessing the money to do that. We need long-term solutions.
3 hands in the air if you want to attract the audience microphones and ask a question. Was that one there? We see one there. Gentleman there in the white shirt. What would you like to ask, mate?
Hi, Ben Brazier from the Commonwealth Bank. We've seen the government really get behind upgrade schemes for things like solar. For me, retrofit upgrade schemes from the government would really help the financials of these decisions for customers. How do you think we as an industry can put forward that argument to government in a constructive way, and how should we position that?
I'm happy to
Please.
have a go at that. So absolutely, I think we talked about that sort of two-pillared approach where we really want government focusing where there's very little financial capacity and high risk, not for partial funding and rebates, but for full support for those households. And then I think blended options are fantastic for the rest of the market, and we'd love to see those CFC approaches like co-funded mortgage discounts, like the Victorian energy upgrades that are in 4 states for home energy rebates and, you know, all of those programs have been so successful, and we just think we don't need to invent new ones particularly. We just apply the same logic to a different but very related problem. So as an industry, I think looking at these blended opportunities would be fantastic, and also, I guess, helping the rest of us advocate for very targeted full funding for First Nations, social housing, looking at where government can play a regulatory or leadership role. So things like we've just seen in the US, where there's a high standard now for flood new builds and retrofits, where government investment is touching those programs. So it's higher floor levels, it's looking at the less frequent but higher consequence floods. So government can really make a huge difference, set up the ecosystem for everywhere else by taking that leadership position. And with the push for housing supply at the moment, this is time critical. We have to get in there and lift those standards, and government can do that. So,
can I ask you quickly, Sharanjit, on that, because we laugh at the act, but the actuaries in insurance were the first people across climate change and have been factoring it in for. But there's still a lot of people who'd be surprised to know there are places on mainland Australia where you essentially just can't insure. Where is government? Where are we at on the education process with this?
The government has started to respond. So, for example, the Disaster Resilience Fund the Disaster Ready Fund that the Albanese government pretty much announced on the second day that they were in power. We're starting to see government policy shifting towards saying we need to build resilience rather than just paying out millions post a disaster, and that is actually a much more effective use of money. That's the thing. Every dollar you spend in resilience, there are many studies out there that show you get massive cost benefits, at least 3 times. I did a study where I said it was 10 times. So we're seeing government understand that and start to push that and put that into what they're doing. We just announced yesterday, I think it was, the day before yesterday, finally our building standards are going to take into account climate. We're building these houses to last hopefully 100 years, and we're building them for yesterday's climate, was the building standards. Now, so there's been an announcement finally that government's put in so that the ABCB has to think about climate. It'll take 10 years to actually get the standards out because it's a very long process, but it's a start and something we should have done 20 years ago.
Final question down the front here. What would you like to ask?
Good afternoon. Chris Cupid from the Council of Australian Life Insurers. This one's for Amanda and Kate. We've talked a lot about property and casualty risk, but there are also health and mortality risks coming in relation to climate change. What are you thinking about in terms of your users and customers and helping to prepare them, particularly for things like extreme heat?
One of our perils is heat wave in the resilience ratings. We've seen that heat wave kills more people than the rest of the perils combined. So that has to be front and centre. A lot of the work that we do for upgrading homes for heat wave resilience provides thermal comfort and reduces emissions and energy use. So there's so much cross-benefit here in looking at things holistically. But health, absolutely number one priority, certainly from our households. So avoiding death, injury, and all of those mental health, domestic violence, all of the knock-on effects that come out from exposure to these hazards.
Alison, is that something?
Yeah, I would add to that, and linked is the infrastructure question. So there's a lot of work, for instance, going on in Greater Sydney at the moment looking at heat stress. It's not actually considered an insurable peril by itself, although it's clearly linked to both mortality and morbidity in terms of that impact. And so that forward planning by government, where in fact insurers are at that table in the discussion as well because we are so conscious of it. Perhaps to add, there's also a link there to interesting tropical diseases moving south. Dengue fever, for instance. And this is something we're also looking at, particularly in the health insurance side.
Can we thank, please, Emma, for moderating a fantastic panel of Alison, Amanda, Kate and Sharanjit. Thank you so much. What a wonderful discussion.